Welcome back. I'm sure by now you have acquired so much wisdom, and we are only about 30% through the playbook, and there's a lot more to unravel. So this is just the introduction to the Model 2, which was founded by the one and only ICT, and we just implemented it into the teachings by considerably ICT's best student being Romeo, who authored the CRT. And using the month 5 of ICT, he introduced the entry sequence. However, he missed out one of the highest probability entries that allows you to almost never be tricked by the market. Yes, of course, you can have a more refined entry, such as the Model 1 being an order block and a total shoot. But this model right here is the safest, most consistent entry that saves you from being tricked. This is just from my own experience. So let's get into it. The inversion fair value gap. Based off of our knowledge, we already understand that the market only does two things. And what is that? The market is either seeking buy stops or sell stops, which other people call lows and highs, or the market is seeking fair value, meaning to rebalance an imbalance. Okay? And if that's the case, the power of the CRT is that we understand where the final destination of the bus is. Meaning, are we aiming for sell stops or buy stops? In other words, are we bearish or bullish? So if price is seeking fair value and is seeking buy stops and sell stops, we use the CRT as a higher time frame bias to understand, are we looking for sell stops or buy stops? And we use the fair value gaps as bus stops on our way to the final destination, being either a buy stop or sell stop. We're going to get into it. Once we've identified, as you can see, we purged a weekly CRT high, meaning we have now purged buy stops. Because dumb money will believe that once we've taken this high, it's a breakout, and this becomes a BISI, which will be a bust stop to support higher prices. However, the members of the Renaissance community will see this as a potential inversion fair value gap. Why? Because once a CRT high is taken, we target the 50% and then we target the full range. As we know, you sell high and you buy low. You don't buy high and you don't sell low. Okay? Uninformed dumb money will anticipate this fair value gap to be a BISI, whilst the informed Renaissance member will anticipate this to be an IFVG. That money becomes a liquidity because they thought, oh my god, it's going to be breakout, it's a breakout. No. We're not pattern traders, we're logic traders, okay? We trade based off of narrative. And the higher time frame narrative was the weekly CRT. And we're using the 4 hour as the entry time frame. So, an IFVG signifies a trend change, because if price disrespects an old FVG, it signifies that price will be looking for further fair value or sell stops or buy stops, which in this case would be sell stops because we have taken the buy stops. When this happens, price typically, and I'm very intentional with my language when I say this, price typically allows those who were trapped to mitigate their positions before the sellers take it down and seek further fair value or sell stops. Stop losses, basically. And that's how you want to be looking at the market. Not in patterns, but you need to humanize the market and understand that this is a stop loss. This is a stop loss. This is a stop loss. Always remember the wicks are stop losses, whether it's a buy stop or a sell stop. Okay? Normally people draw a red box to signify that the buyers are trapped, so the market will give them a second decision. Once this occurs, go back. This is an entry. Okay? Aggressive entry 1. We target 50% of the range. You can always use this as a stop loss because it's the displacement candle, and we will not be anticipating price to ever reach back up here. And if it does, unless there's a rejection block, 9 times out of 10 you're wrong and price is going to continue higher. Okay? Especially when an order block has been created, which is the model 1, as you can see. The IFVG confirms CSD and the order block. And as you already know, as I've said previously, it signifies a trend change. It's the earliest sign of a market structure shift before the breaker block has been formed. Okay? And I'm sure from your experience, you can be tricked by an order block. Very rarely, it's almost impossible, can you be tricked by an inversion fair value gap. Okay? Keep that in mind. And anyone who denounces this entry model simply doesn't understand the structure of the market, and they simply don't understand the narrative of the market. Because if they ever talk against it, ask them, what are the 2 things the market seeks? And if they don't say fair value, that's enough for you to know. Okay, continuing. Aggressive entry number 1. Stop loss above the displacement candle. Okay? The market will give the buyers who are trapped a second opportunity to let go of their positions before the sellers enter the market and take it to seek fair value or sell stops or buy stops. Okay? For example, here, and many more here as well. Yeah? Is this your second entry? Always when you're in a trade, always mark out your invalidation point, because this is the logic. Every stop loss needs to be logical. Anytime you place a stop loss, make sure your stop loss is in an area in which liquidity has already been taken or stop losses have already been mitigated. Okay? And that's how you place a logical stop loss. This is a stop loss. This is a stop loss too. Okay? So, once you enter, which if you've already seen the risk management page, you understand that for me personally, my risk management is 1% a day. So that means you could have entered here at 0.5%, and this could have been your second entry at 0.5%, making it 1%, and now you have 2 positions with a tighter stop loss when you're up here as well, and you would have continued downwards. Yeah, as you can see, 50%, we take 50% and 50%, and we move our stop loss to break even. Yeah, or as I tell my students now, have a fixed risk to reward ratio, which will be coming in the next chapter. Okay? It is easier to build a system and think in a computational way if you have a fixed RR, because then you can see and document your wins, and you can find out your win rate. Okay? As I've already told you, a free risk to reward ratio with 10 trades in a month with a 50% win rate equals 10% in a month. And for many of you, that is enough. For everyone, that is enough. Because then you can focus on building capital. 10% a month on a 100,000 account is still 10k a month. 10% a month on 500,000 is 50k a month. 10% on a million is 100k a month. And in a year, it's 120%. Now, I don't know about you, but that is more than enough for someone to change their life. Okay? I've told you countless of times, and I pray one day you guys understand this, that nobody posts their losses on Twitter. I've already explained it in the other chapter why I do not, in the chapter of negative for loops. However, I always let you guys understand that there is no such thing as 100% and no one posts their loss. Okay? A majority are trading on their demos, which is great for their own journey. I understand it, but if they get stuck in trying to impress people instead of trying to make money, they'll end up just becoming demo Twitter traders, and that doesn't help anybody and doesn't help themselves either. So always keep that in mind, okay? A 50% win rate is good enough. A 30% win rate is still profitable, okay? 10% a month is good enough. 3% a month is good enough, because then you can focus on capital rather than focusing on having a 90% win rate, okay? So, as you can see, we targeted 50%. You move your stop loss to break even, and that's enough. If you target the 50%, as Romeo has once stated, it's almost guaranteed. Targeting just the 50% is a high win rate in itself. It has a high hit rate, from my experience too. Romeo isn't lying, okay? And this is just further information on the same thing again. You see? This would be a the daily Monday Midas model taken. All of these people, suck it in. Everyone here, that stop loss, finished. Trapped. FVG, they gave them a second opportunity to let go of their positions before the sellers enter the market. Okay? Always keep that in mind. Always keep it in mind that the market only does two things, and it only seeks two things: buy stops, sell stops, and fair value. Use the CRT to determine the buy stops and the sell stops, which meaning the market sentiment of where the market is heading, and use the fair value gaps as boss stops. One thing I haven't included into this is you can use inversion fair value gaps for continuations also, but that will be left till the end of the playbook. Thank you for listening. I'm sure this has helped. Make sure to backtest 6 months of this. Okay? Do video breakdowns of every backtest. Document the win rate. Document the conditions and the days. And you're welcome. Take care.